Good morning, everybody, and thank you very much for joining us at NEPC's first insurance-focused webinar. We are casting live from our investment conference in sunny Boston at the moment. We've had a terrific day and a half already. We had some fabulous speakers yesterday, and we are joined by 4 more fabulous speakers to talk through insurance companies moving into the asset management business. Just from a logistical point of view, the tech person in my ear told me that I've got to point out to everybody that there is a question box in the lower right corner of your screen. If there are any questions that you would like to pose to the speakers, we will address those at the end, and we hope you enjoy the webinar. So I will pass to the speakers to introduce themselves. So to my left, I have Tripp.
Great, thank you, Andrew. I'm Ann Tripp. I'm the Chief Investment Officer and Treasurer of the Hanover Insurance Group, which is a property and casualty company in Massachusetts, Worcester, Massachusetts. We have $5.3 million of net written premium, and we're geographically across all 50 states, and a diversity of products. So we're about 40% personal lines, 38% commercial lines, and 22% specialty lines. I have another hat at Hanover, and that's as president of Opus Investment Management, which is a wholly owned subsidiary of the Hanover Insurance Group. And Opus manages currently about $11 billion of assets under management. $8 billion of that is associated with the affiliated parent, and $3 billion is with about 35 clients outside of the parent, unaffiliated. We have a strong focus on insurance company asset management. About 95% of our clients are insurance companies. We really provide not only asset management, but we provide services that really complement insurance asset management. So we do insurance asset management because we understand both sides of the balance sheet. It's not just about investing assets, and we also provide portfolio reviews and investing insurance for our clients. We look at regulatory environments for them. We help them with rating agencies. We do all types of reporting, including all their investment accounting if they want, and I think I said that, and rating agencies. So very comprehensive. We can also support them on the custody side. So very comprehensive asset management business. So we looking at both our affiliated and unaffiliated clients.
And David.
Great. Well, thank you, Andrew. It's great to be with everybody today. Dave O'Malley. I'm President and Chief Operating Officer of the Penn Mutual Life Insurance Company, as well as CEO of Penn Mutual Asset Management. Just a little bit of background, I started at Penn Mutual 25 years ago in the investment area when the company was about $5 billion in assets. We're around $30 billion today. And really, we have a rich history. We're a 172-year-old insurance company, the second oldest mutual insurance company in the United States. And what we've really seen was the opportunity to be able to continue to grow the company by focusing on diversifying our sources of earnings. So as we've had great success in the individual life and annuity businesses, and our assets were able to continue to grow, and we've had strong, sustainable results there, we saw the opportunity about 5 years ago to bring together all of our investment resources under the Penn Mutual Asset Management name, really with a key focus in fixed income first and foremost, sub-advisory services, and then a deep history in alternative assets. Our extensive and deep credit bench, as well as our expansive structured securities team, allows us to have areas in the marketplace that we can provide niche solutions to select clients. We believe that overall, our liability-driven investing and managing interest rates in this decade-long low interest rate period has given us unique perspective into opportunities, solutions, and techniques to be able to manage through this environment. But in order to have sustainable and long-term results, the culture of the company is key. And so we very much focus on our people and their commitment back to our clients through a culture of meritocracy that has allowed us to have very attractive levels of retention, been able to allow us to continue to attract top-notch investment talent to Penn Mutual Asset Management.
John.
Great, thank you. My name is John Orner. I am Treasurer and Chief Investment Officer for Blue Cross and Blue Shield of Minnesota. And like others here, I also preside over our asset management company called Aware Asset Management. We are 87 years old, not quite as old as Penn, but in the health insurance space specifically, unlike others. Similarly, we have a deep experience relative to managing our assets internally, particularly on the fixed income side. I often say, we make CIO decisions feathered with CFO decisions, because oftentimes managing the strategies of the balance sheet, managing risk-based capital and other sensitivities doesn't necessarily fall under one particular vector. It really needs to be taken into consideration with both. And that's a real strength that we bring, the experience, the collaboration, the analytics, and ultimately the performance. We've got several sleeves of product. We just launched an ETF, which is fixed income based, the ticker AWTM. In addition, a core bond portfolio, an intermediate credit portfolio, structured opportunities portfolio, and then really, kind of a green field relative to flexibility around other alternative approaches. These are all under the separately managed account space. So happy to be part of the conversation today.
And Tom.
Thank you, Andrew. Good morning, everybody. So I joined Sun Life about 8 months ago. Prior to that, I spent about 20 years at Mercer. Sun Life Investment Management has about $160 billion of assets under management. It's a business that we've grown over the last number of years through, I would say, internal growth of the general account capabilities and bringing that to the external marketplace, as well as selective acquisition. We're very much focused on what I would call yield-oriented asset classes, similar to the rest of the panel. It won't surprise you that we have the full range of public fixed income all along the maturity spectrum, as well as the credit rating spectrum. We have a deep expertise in private fixed income, particularly investment grade private fixed income, and we have a global real estate platform. So we have an acquisition that's actually due to close in about a month's time. That will give us a global platform across North America, Europe, and Asia, real estate, equity, as well as real estate debt. While I was at Mercer for 20 years, I started the OCIO business in Europe for Mercer a number of years ago. I moved to Boston and ran the OCIO business in the U.S. Both of those businesses are now in excess of $100 billion. And then my last role at Mercer was running the U.S. wealth business, which is the aggregation of the investment consulting business, the OCIO business, and the retirement and actuarial business. To give you a little bit more sense on Sun Life, I imagine Sun Life's relatively well known to everybody on the call. I don't know if we win. 150 years old. Maybe it's a tie. But a 150-year-old organization, and similar to what everybody else has just said, an extraordinarily deep heritage in understanding how to manage assets against long-term financial obligations. And when I think about this from a client perspective, I think we very much, maybe we all do, share the same purpose as our clients in many ways. So we manage assets against long-term liabilities. Our insurance clients, of which we have about 80 insurance clients externally, manage assets against long-term liabilities. Our defined benefit plans, of which we have hundreds in terms of clients, also manage against long-term liabilities, as do endowments, foundations, and high net worth. So when we talk to clients, and I think it's probably unique to the four of us and maybe to insurance asset managers, but we can truly sit in our clients' shoes and often have peer-to-peer conversations because we're trying to solve the same problems, and then act as an extension of their staff in a way that maybe is unique.
Terrific. Thank you, everybody, again for joining us. My name is Andrew Coupe, and I am a senior consultant with a insurance focus at NEPC. NEPC provides investment consulting services to a broad range of investment pools, and we have a good number of those in the insurance space across life, health, and P&C companies. So with that, the agenda for the sort of next 45 minutes is to talk through some investment issues, some governance issues, and some business issues that you as insurance companies have faced. So with that, I certainly don't want a rigid format. I will ask a question, and please, any of the panel step forward to answer it. And the first question, which some of us have touched on already, is what are the investment pools that you're looking to target? Who do you see as your target clients? And specifically on the investment side, how do you add value to those clients that you partner with?
So I'll take a first stab at it. This is Tripp. We look to partners mostly with insurance companies, and I would say smaller insurance companies in general, or those in the alternative space, so the captive insurers, the risk retention groups, self-insured groups, or small P&C companies, or small life companies, or small health companies. That's really our target market. And as many of us have said here, the reason we do that is because we understand there are two sides of the balance sheet, and we don't invest the assets uniquely. We do it within the context of the liabilities. We understand how to do that. We understand how to think about liquidity. We understand how to think about how much you should have in risk assets versus your surplus, how rating agencies will perceive the investment management. So that really is our target market because we think we can add value. Our philosophy is that yield wins over the long run. So like others, we're very yield oriented. We therefore have to structure our portfolio to provide liquidity, but we are striving to get yield to provide that income ballast for the insurance companies. So we want to provide net investment income that really can provide the ballast so that when combined ratios are above 100 and you may be losing money because it's part of the market cycle, you have this ballast of income, or when it's below, you're growing your surplus. We focus on fixed income, but we also do some work on the risk side as well for the insurance companies.
I'll just add to Ann's comments, John Orner here, in addition to that, in a similar space, right, but focus on the health insurance side, where asset management really takes that niche approach to things relative to opportunities in the market. Ann, you had mentioned liquidity. We live it, we breathe it like you. Seasonality is key. Cash is king. It's actually a worthwhile asset group again, but we've never taken our eyes off of that liquidity piece because that's ultimately, where you pick up nickels and dimes in moving out in duration. The other area of our business that, beyond helping clients structure liquidity vehicles, whether they be LOCs or leveraging the Federal Home Loan Bank, is also a fairly deep set of experiences in the medical banking space. We have a subsidiary called Further, which is a health savings account business, which operates in that space, and it just really shows the opportunistic side of a different kind of side of the business that is augmenting the health insurance or whatever insurance play there is that where asset management can be very beneficial.
If we maybe change the direction a little bit and move to either David or Tom, because I know you both have sleeves of business that deal with alternatives. Can you maybe focus on the alternatives assets that you provide and how they can add value to clients?
I mean, from a Penn Mutual Asset Management perspective, we've had a long history in alternatives, whether or not it's our relationships in Silicon Valley, whether or not it's in small middle market buyouts, other unique asset classes, be it on the credit side. And so that's a deep area of relationships that we continue to look to work with. We think that a lot of those require access. They require relationships that are built over decades. So it's not just coming in and having those dollars. It's being able to be a good partner on that side. And we think that they provide a good complement to a mix of business overall.
Yeah, and then if you want me to add to that and kind of complement, so in addition to, I suppose, what everybody else has said, maybe the real estate piece is a piece we haven't touched on. A very important part of the kind of capital markets, whether you're an insurance company, defined benefit pension plan, or a high net worth investor. So from a Sun Life investment management perspective, like I said, we have built out a global real estate platform, which when we close the acquisition of Green Oak will probably be around $40 to $45 billion in assets. looking for, real structural alpha. Many of our equity counterparts, we heard yesterday at your conference from Larry Fink, it's a zero-sum game. When you're looking for a real structured alpha and value add, real estate, I think, is a place that everybody would go. So we cover core plus, opportunistic, value add, right across, like I said, North America, Europe, and Asia. And then specifically, I think from an insurance perspective, commercial mortgage loans and real estate debt, very important in terms of diversification, very important in terms of producing that little bit of additional yield that we know everybody is looking for.
I think, Andrew, one thing that I would add is that we've taken maybe a slightly different approach to a couple of the opportunities. We very much are total return focused. So as a mutual company, we've focused on total return and driving long-term ability to increase income versus short-term yield driving income in the short term. And so for us, areas like real estate, we go through the structured side. We actually unloaded our entire real estate business, feeling that basically we were carrying along a big operation that basically we had to make loans in every market environment. Versus in the CMBS space, where we've built deep talent, we can then decide where we want to be in the capital stack depending on where the risk is. And then so really underwriting those loans in the secondary market to define value that way. And I think that's one place that we've chosen to separate ourselves, is that really understanding that structuring, being able to move up and down the credit spectrum and being able to offer that skill set out to others. That has served Penn Mutual well through the financial crisis and since. It's something that we offer that I think is unique. It really starts with that total return bias that leads to increased income over time.
Terrific. And maybe I can sort of ask the next question as a follow-on to that, David. You talked about sort of the cycles and how your investment business has changed. I will ask the group, why now? So given the economic environment, given the low rate environment that we've lived through, and the questions going forward on what interest rates would look like, maybe there were some comments from the table of why is it now a good time to partner with your organization given the macroeconomic scenario?
Okay, I'll pick that up. Why now? Why now is when you're looking in an interest rate environment where we have been in, which is very low, you have to be able to have an investment manager who can really pick the appropriate credits, especially as we're heading into what might be coming towards the end of a credit cycle. So you want to be positioned correctly. You just can't be buying any asset. You have to be thoughtful about what type of assets you pick. In the P&C industry in particular, when you're in a low interest rate environment, if you want to keep your earnings stable, you have to bring your combined ratio down even further to keep stable earnings. So you either have to figure out how to do that or how to make your investments work for you appropriately so that you can do a combination of both. So having a astute asset manager who understands the liabilities and what's going on there and can complement it with the investment strategy is, I think, incredibly important in this low interest rate environment for that reason.
Yeah, let me just build on that, because I think why now depends on where you're coming from, quite frankly. I think if you're a small, mid-sized insurance player, guess what? It's an extraordinarily competitive market out there. And so any point in time that you can find an edge versus your competitors, it's something that you should very seriously consider, whether that's an investment edge, through partnering with somebody like any of us around this table, whereby, I'll give you an example, whereby you can access kind of proprietary origination of capacity-constrained private assets. If it's not something that your in-house team can have the capacity or has the experience or ability to do, then to find a partner who can sit beside you, like I said at the start of this, who has a common purpose and understands the shoes in which you stand and can help you access areas of the marketplace that you can't get to yourself, that makes just eminent sense. If you're a larger insurer, maybe you're not looking for the hand holding, the full service of investment, actuarial, accounting, et cetera. If you're a larger insurer, I think it's the same thing. You're looking for an edge, and you're looking for access to capacity constrained asset classes or structured alpha. And so real estate, and again, something like investment grade, private fixed income makes eminent sense. And then I know this is insurance focused, but a very big part of our business is defined benefit pension plans. And what are they trying to do? Well, they're trying to manage interest rate risk and mortality risk. And who understands interest rate and mortality risk better than an insurance company, particularly an insurance company that's been doing it for 150 years. And so as the DB pension market shifts, as it starts to de-risk, people start to think about, now I've got 80% in fixed income. It's not good enough to have a Barclays long credit mandate. It's not good enough to think about core. You got to be much, much more sophisticated. You got to start using some of the techniques and capabilities that insurance companies have used for years. And so we've had many conversations with DB plans around, again, private fixed income as a complement to their public fixed income within an LDI context. And ultimately, having sat on the consultant side of the table and seeing this in action, ultimately many DB plans are thinking about the end game. And what does that mean in terms of de-risking? What does it mean in terms of annuitization and buyouts? Again, guess who understands how the end game works? An insurance company. So I think there's many, many reasons as to why now. I'm not sure they're going away, so it might be why now today and why now tomorrow. But I really, really think we're all in a unique position to help, as I said, long-term investors with these obligations that they're trying to meet.
Yeah, I'll just add on to that, John Orner here, relative to the why now. And I think, too, there's, with fee compression, with the crush on rates, having gone a decade now or so. There's also kind of a big whale kind of component here too that says there's a need for some nichier kind of activities, some ability to get into the corners a little deeper and find value. And you don't always find that with the whales, if you will. We all know who those are from a manager perspective. So we feel that that's a great opportunity, ultimately coupled with that balance sheet strategy. Again, the CIO versus the CFO decision has a lot of value to it. And I agree with you too. The why now today might be very different than the why now tomorrow.
I think as we continue to see insurance companies look to differentiate in the products that they offer, to define their markets more tightly, it does create liabilities that are very specific insurer to insurer. And I think that having the exceptional client service, the ability to understand the perspective, to be able to tailor niche solutions to do that, is a differentiator that we can offer at the table rather than the very large asset managers who more have a packaged solution. Yes, maybe they have all that, but really understanding at the core what a client is trying to accomplish, how they're trying to accomplish, what their needs are, what are their balance sheet concerns, what are their income statement concerns, how can we structure a strategy bringing together some tried and true investment techniques, but also really understanding what they're trying to drive in their business. I think it's something that is an opportunity in the marketplace to be able to provide that service.
I mean, if I can build on that, so when we're talking to clients and we're kind of discussing the value proposition, and again, this might be common to all of us, but so I talked about purpose and this kind of common sense of purpose. The other thing we talk about is alignment and also results. And from an alignment perspective, we co-invest alongside our clients in many instances. So, for example, in the private side of the business, we sit alongside them literally, and therefore a win for them is a win for us. We actually only win as long as both of us win in that instance. But the reason I wanted to pick it up was on the results side. When we talk to clients, we talk about results in two ways. One is the traditional investment alpha, right? We're all here in the results business, quite frankly, and we'll be judged by results. So there's investment alpha, but we're like you, David. We're very, very focused on what I would call client service alpha. In the world in which we live in, it makes such a difference to be able to service your clients in a highly customized, white glove way where they understand that. I know we used the phrase whale a second ago. Certainly from our perspective, they understand that what they're getting is absolutely 100% customized to their, not just their liabilities, but to their business and to the business problems that they're trying to solve. So again, in terms of why now, I'm not sure maybe that's a slight tangent, but it's kind of building upon David's point around client service.
So the final question I have for the group, and you please all forgive me for being indulgent, a project that I've talked about is the financially engineered NEIC capital-friendly products that seem to have really emerged in the last 12 to 18 months or so. We have a couple of people here who serve as both CIOs and now on the asset management side. Maybe if someone has a comment on sort of how you think about it, was it something you were doing on your balance sheet anyway? And as an asset manager, are you looking to use these sort of packaged, financially engineered structures that might give you some NEIC relief?
So I can answer from a Penn Mutual perspective. From the insurance company perspective, we are not. It's not a product that we are comfortable with. We think that that creating and taking investment risk in, I'll call it packaged form to basically get an RBC outcome is just misleading yourself to the risk that you're adding to the company. Now, I know that we're all in trying to sort of say where should our capital levels be, but as a mutual insurer, we have a strong belief that these type of products are not good for our industry. They create problems down the road. They're a byproduct of the fact that we have a low rate, low return world, and that there is a very competitive series of new products in the marketplace, but also in-force issues that companies are trying to manage to be able to eke out extra return, in particularly to service some of the guarantees that are embedded in the in-force book. So it's not an area that we've gone. It's not an area that we would recommend, and it's something that I think that we need to continue to watch out for as an industry.
I think at Hanover and Opus, we feel the same way, and we think there's a fee component to it that makes them expensive in the long run, and we would rather do the component parts and get the right return to manage our balance sheet appropriately without using sort of synthetic product to get there. So we have not been a player there, and I don't expect that we will be.
Yeah, I would just add there's a different level of expertise sitting at the table answering this question. So, those are kinds of things that appeal maybe to the shops that are smaller, that outsource, et cetera, that would have kind of a turnkey approach to managing their RBC and other financial levers.
Terrific. So now move into the governance section, and if you would all like to sort of share your experiences, thinking about how your insurance organization decided to transition into the asset management business, where the idea was generated, how you had to sort of get through the door. I open it up to the panel if anyone would like to discuss your path to asset management.
Well, I could start. You've been starting, Ann. I'll start to kick it off here. So,
Great.
John Orner, Blue Cross. We started this. It's actually been a redo of a concept back in the early 90s, but effectively it was a way to, and I'm sure this theme is going to play out here, a way to leverage the existing staff for obviously working towards asset management for our own good, bringing on the right talent, bringing on the right technology and experience set. So why not turn that outward, again back to the philosophies around CIO versus CFO and various balance sheet strategies, effectively monetize that in a way that is translational to organizations that need it, don't want to staff up in the same ways, don't want to have that expense/liability, and are looking for someone that are kind of quote unquote like them to do this as an outsourced opportunity, and we fit right into that theme.
So from a Penn Mutual asset management perspective, our journey down this road started about 5 years ago when we went through a transition in leadership in the investment area. And we, as a board, were looking at where did we want to be, how was the business growing overall, and realized that we had this deep bench of investment talent, but it was kind of in different areas of the company. And so we really consolidated the insurance asset management capabilities with what we were doing for our separate accounts and for our separately managed funds, and pulled them all together with really a keen focus to be able to attract, retain, develop the right talent, but also to be able to bring our associates together with a real focus towards increasing and really building the control governance environment for the future. So right down the line of this governance question, things that we had not had in place. We were not GIPS compliant at the time. So going through that over the last 5 years, now fully GIPS compliant back for that over that last 5 years and beyond, being SOC 1, increasing the internal controls environment, investing in that, focusing in that area, those type of things, and then also really looking at our service providers. And so for us, really understanding when we look at the insurance company, the 40 Act funds that we manage for our variable products, the RIA responsibility. Do we have the right service providers? Have we created the right structures in place to make sure that we have good separation of duty? So governance drove actually a lot of it. We know that we needed to have the governance and the structures in place in order to be able to use this to be able to diversify Penn Mutual, the broader company's earnings over time. But really, it was that pieces of the pie that have been put together for us over the last 5 years that put us in the position that we feel very good at scaling.
David, you said something that I thought was very interesting in there, because as we all sort of are on the insurance circuit, we time and time again hear what is the biggest problem that insurance companies face going forward, and it's talent recruitment. That the insurance is not necessarily viewed by people coming out of college as quite as sexy as the Silicon Valley firms. Can you talk to how the asset management has helped in that? Has it been successful? Have you been able to get quality talent because having an investment arm in place?
I believe so, and it's not been just able to recruit them, it's been able to retain them. We've had zero regrettable turnover in the last 36 months. We've been able to bring in, our CIO joined us from a large state pension plan. We've been able to draw people from traditional asset managers, and we really lead with culture. Because at the end of the day, compensation is important, but if you look at all the surveys out there, it's not in the top 5 things that keep people at firms. And so what's the purpose? Who are the people they're working with? What are they working on? So we feel like, when you can have a compelling proposition, compelling position in the marketplace, you set people up so that they can have exposures and develop their career, and not only can attract the right people, you can retain them. And we've been able to do that with both experienced people, but also bringing in people early in their careers, even those right out of school.
I just talk about Opus a moment. Ours was really grassroots driven. It was really bottom up driven. We had this investment group at investment department at the time. It was very talented, similar to what David and John have both spoken to. Very talented, and they wanted to be able to create a business out of this. And so it really was grassroots driven. But from a parent company perspective, what was really sold are the 2 main things were fee diversification, diversification of revenue, so fees coming in, and the talent management. And the talent management is incredibly real. For us, we focus on small insurance companies. So when I say small, I'm talking 300 million below. And it was not only talent retention and attraction for the people in the investment department who are now Opus, but it's also leveraging the entire insurance company, because we provide reporting, we provide investment accounting, we provide some treasury services in terms of rating agency relationships. And everyone likes having that ability to deal with people outside of the insurance company, being challenged and dealing with complexities that we may not be dealing with internally. It's different for every different client, and having that is actually very stimulating for the talent. And so we found it's been huge from a talent management perspective, and people just love, even outside of Opus, being able to work on third-party clients.
Let me jump in for a second. I mean, from a Sun Life perspective, Sun Life's been in the asset management business probably longer than I've been alive. On the basis that you can't see me, you'll have to guess how long that is. But Sun Life, as many people will know, is a proud owner of MFS, which is one of the the preeminent global investment management firms in the world. So Sun Life knows how to run an asset management business. It knows the balance between being involved and not being involved, and I won't get into any more detail than that, but there is a balance that you need to find, and a culture, to David's point, that you need to create in an asset management environment, which I think is different than a culture that potentially exists in an insurance, a traditional insurance environment. But to me, the question of why are we in this space, it kind of doesn't really matter what we think, quite frankly. All that matters is what are clients looking for, and what are the unmet needs of clients. And to me, the unmet needs of clients and why Sun Life is in this space is some, and this might sound a little bit repetitive, but they're looking for partners who are genuine partners and who understand their problems. And they're not looking for product providers who are one-trick ponies. They've got one capability and they just want to sell it all day long. That's a dying breed, quite frankly, and the partnership word is used quite a bit. I'm not sure that many people can really stand behind it in the way that we've talked about here. I think they're also looking for a partner with broad capabilities. I mean, if you look at the trends in the asset management space, clients right across the board, regardless of segment, are looking to reduce the number of asset managers they're trying to work with. Why are they doing that? Maybe for their own governance needs, but also so they can actually get true partnership relations with somebody who is not fixated on any one particular discipline or one particular capability, who understands the problem and then can help them build the jigsaw with kind of the multiple pieces that are required to solve a client problem. And then I think they're looking for that investment alpha and client service alpha. And I think we around the table understand that client service piece in a way that maybe, again, I'll go back to the whale, but maybe in a way the whale maybe has forgotten. So unless the client actually feels that there's unmet need, we could also have asset management companies, and it would be a short journey. But my sense is we're all in this because this is where clients see them and their businesses going, and they need partners to help them get there.
So Tom, I'm not sure you can speak to this because you say Sun Life has been in the asset management game for a long time, but I can imagine with my experience of going to a board with an idea like that, there are certain board members I can think of who might use some very colourful language when that idea first gets risen. Maybe we can sort of hear from sort of the points of resistance that you got from maybe boards or other members of management as this idea sort of bubbled to the top. What was some of the pushback that the organisation or boards might have given you?
Some of the pushback we got was a pulling of money that might go to support growth in the P&C business, now had to go support sales and marketing. But that quickly dissipated. I think that was one concern. I think the other was, would you forget us, and just focus on your third-party business? And one of the things that we did is everyone's a client of Opus. So even the parent company has a contractual relationship with Opus. So they're actually benefiting because they have a client. We deal with them as a client, and we deal with them in the same way that we bring superior client service to them. So that concern about wondering where our attention would drift was dissipated by putting in these contractual relationships with everyone in the same way. And that helps from the governance, that helps from SEC, because you have a relationship with everyone, so you're not favoring one over another. So I think our biggest obstacles were, where is the money? We don't want to divert money to something unless we think it can be successful, and also the attention. And that was both of them were easily managed.
Yeah, I'd echo what Ann said. Our challenges were fought off pretty quickly. There's a few members of the board that focused on audit and compliance, and David, to your earlier comments around being GIPS compliant and SOC 1, we jumped through a lot of those hoops to ensure that those things were in place, that we had a great compliance view, chief compliance officer in place, checking all those boxes. Kind of quickly allays the good side of that, and that's revenue diversification. I often tell the board and remind them that, we're eating our own cooking, so similar, the entire organization and the assets in that are managed through Aware Asset Management. And so that brings, I think, once you get over those compliance issues and concerns, it actually brings a closer relationship then with those board members that were maybe originally a little bit put off by it.
So taking one more step, and one other area of governance that is very key for insurance companies is the rating agencies. And a lot of the buzz across AM Best, across S&P, across Moody's, has been sort of what are insurance companies doing different? How are they looking to the future? And really sort of giving credit to people that have done things that are unique. Has that played out as you sort of talked about adding investment arms? Can you talk to how the rating agencies might have responded?
I'll maybe start with that because they literally just were in my office yesterday, both Moody's and S&P, and very favorable. So back to the revenue diversification, what's different in your world, the health vertical, can be stale, I'm sure, just like any of the other insurance lines. So that played very well. It wasn't, kind of on the top 10, if you will, of things that they were asking about, but certainly played in the orchestra around the positive future outlook.
I would agree. For us, it's been the positive view of having earnings diversification. For us, our core life and annuity earnings have quadrupled since the financial crisis, and so being able to have 20% of our earnings coming from the combination of our asset management business and the ownership of a very large regional broker-dealer, that has helped keep rating stability for us. So when we look at it from an enterprise perspective, we've definitely gotten support from the agencies by doing that.
I would agree with both those comments. The other thing I would add is that our clients, when they deal with the rating agencies, they get a lot of support that they're dealing with an asset manager who understands insurance.
Yeah.
So that is very well received for our clients, that we can talk the talk and help them from a rating agency.
Perfect. I think that covers all the questions I had on the sort of governance side. Maybe we can move for the last section and talk about some of the business challenges for the insurance company. And sort of as they evaluate the asset management arms, what sort of KPIs are you folks being measured against? What is the insurance company looking for in a diverse source of income?
We really have three main KPIs, if I look at it, that align the incentive compensation for the investment professionals to the KPIs that the board is looking for. First and foremost is, are we growing net income? Is the unit performing from a financial perspective as expected? Second is the variety of investment total return metrics. Every client we have is total return based versus an index, including the insurance company has been for 25 years. And then really the third piece is the performance of our sub-advisory selection. So how are our sub-advisory, the dollars that we're not managing directly, how are they performing versus benchmark versus expectation under that manager selection? Really, I could take that deeper. There's probably more components, but it's really those three things that flow from incentive compensation at the Penn Mutual Asset Management level to board-reported statistics.
Yeah, I'd simply put for Aware Asset Management, it's AUM growth, revenue growth, and performance. It's kind of that simple.
Yeah, I imagine we all have similar financial metrics, which won't surprise anyone. And maybe I'm sounding slightly repetitive, but we also have client metrics. So there's the financial side, there's the client satisfaction side, and quite frankly, the second drives the first. So very focused, obviously, on financials as a publicly quoted company, but that's led and driven by how satisfied and how happy your clients are.
I would add one more KPI to that. We look at it also, the board looks at it also from an expense perspective. So we look at the expenses relative to now for the insurance company, they're diminished, correct? Because we're spreading it over third party. Does that keep you competitive? And what is your NII as a percentage of gross investment income? What's the basis point charge when you bring it down that we're paying for you to exist today? So that adds to all that. But we look at it not only from the board, but we go quarterly to the quarterly business review. So when they're evaluating our personal lines business, we're also evaluating Opus as a business. That's how the parent looks at it.
So this might be a tougher question than some of the softballs that I've thrown up, but what is the time horizon that you're going to be judged for success over? At what point, how long is the rope? At what point might you sort of get the tap on the shoulder and say, this isn't working? Do any of you have sort of any comments or a sense of sort of how long that might be?
From clients or the parent organization?
From the parent organization. As a consultant, I know how long the rope is for clients.
So when we sold the idea to the board originally, we were very direct and said, the sales cycle is long and bringing in clients, and so expect 24 to 36 months is just the beginning when you're starting out building your asset management business. and they very much, we met those metrics as we were building and surpassed them actually, but we pre-sold that because we know it's a long sales cycle and we didn't want to be caught having people look 12 months in and say, guys, where are the clients? So the parent company was very willing to give it a 3-year build in the beginning.
At Aware Asset Management, the parent company, Blue Cross, there really is no horizon. It was really pitched by myself as a tool for the organization, and I mentioned a couple of our other ancillary businesses that can benefit from that going forward. So, we took it as we've talked about here, it's an internal set of professionals doing decades worth of great work. Let's turn that outward, further leveraging it as a tool. So there really is no horizon per se. Now, obviously, your comment earlier, Tom, clients and things of that nature will vote with their feet if performance and some of those things aren't exemplary.
Yeah, I would say, like I said, we have $160 billion of assets, and we're probably out of the probation period. And so the conversation is with the parent, it's more about degrees of success, quite frankly, and setting what I would say, I would say this, but relatively challenging goals for us, both from a client perspective as well as from a financial perspective. And touch wood, we've been hitting those goals, but our trajectory from here is I think about degrees of success and degrees of innovation and growth in clients and segments.
To that point of degrees of success, because I don't view that there is a time frame, right? This is our structure for doing business. Our organically generated assets are growing 5 to 7% per annum, and that's not going to change for the foreseeable future. It's just kind of how individual life and annuity works. The dialogue is more so, what if we're wildly successful? What happens if we attract too many assets? High quality problem, because I completely agree with Ann. The sales cycle is very long, but actually our board discussions have been, what happens, could that create an issue down the road? So for us, it's been which clients do we want to work with? Which clients are the right clients for the long term? Not that every client's going to be the right client. So our board conversations are much more around getting the right clients with us for the long-term relationship, not necessarily trying to attract as many, because I think our problem would come internally if we were so wildly successful, and then the question would get quickly into the distraction value, is the culture of the firm changing, all those other things that come with that. So a little bit different, but I think the structure is well in place. This will be the structure we have 5, 10, 15 years from now. But a little maybe different answer, because actually our conversations have more been around what happens if it's really wildly successful and the outside assets start to grow much quicker than the internal assets.
Terrific. Now, the final question that I would like to sort of get your opinions on is discuss some of the challenges sort of during the process that you didn't anticipate as you went down this path. What sort of emerged that you were like, okay, this was a really challenging issue that you maybe didn't anticipate at the start of the process?
Yeah, I can start that out, John Orner, and I'm going to go back to the resources. I think, although I anticipated some challenge from human resources as it relates to comp and incentive, it was hard to bend the light curve a little bit relative to an 87-plus-year-old health insurance company and the HR practices, and that's not a knock on them as much to say this is a different business, a different vertical, a completely different culture, and therefore it drives a different set of baseline relative to base and incentive comp. So, we made our way through that, but it wasn't without a lot of energy and calories spent in the process.
Building out the infrastructure for client service. So we've really spent a lot of time, energy, and effort in being able to even outsource our investment accounting across all the different asset types and all the different client funds that we have, be it private, public insurance, and then having consistent reporting and being able to do that in a scalable form. So leveraging reporting tools, leveraging single versions of the truth for data infrastructures to be able to generate reporting. I'd say that was the piece that it was a lot of energy, a lot of work. probably never done there, to be perfectly honest, but going from where we were as a company and having a couple individual life companies as clients to now being able to have a structure across public-private funds, that took a lot of time, energy, and effort, and takes, I think, a lot of dedication and will to stay focused on it.
So we are coming to the end of the session. I left some time for questions, and we have one question that came in, and it is a great one. So in the context of earning non-affiliated assets, is the panel concerned about private equity movement into the space and how that will impact you gaining share in the market? I think that comes off the back of a Wall Street Journal article this morning that talked about a large private equity firm that is aiming to hit $1 trillion in a very short time.
I think it's a different space. Yeah. I don't think we're, I can speak for us, we're not focused in that huge assets. I think you've heard talk a lot in this panel about client centricity, the right client, servicing the client, understanding their needs. That's not about volume necessarily. That's about being able to provide value in a targeted area to a series of clients. So different sphere of the market. I think there's a lot going on there. There's been a lot of stories about that. It's probably impacted our non-asset management businesses, more so seeing non-traditional capital come in as what it's done to product pricing across a whole different series of spaces. But for us, it's not something that we're focused on or worried about from an asset management perspective. I think it's well said.
Terrific. Well, thank you everybody for joining us this morning. I have very much enjoyed the discussion. I hope that the audience has found it terrific as well. I do have to provide a quick compliance note from our compliance officer who wanted to share that we do have a research group, and although we have some terrific folk around the table, this is not necessarily a reflection of their views, and that everybody's views may not be the same as NEPC. So I hope I've avoided trouble there. It's been a terrific discussion, and thank you everybody for your time this morning.
Thank you.
Thank you. Thank you.